Hi, Venkatesh Murthy here. Welcome to Money Anchors. So, this is more of an educational series on how to maximize your profit by shifting a position to better strike price with a higher premium. So, I'll show you how. If you see the screen, I have sold 17,600 put option at 26.42, and at the moment it is trading at 8.15. The premium has already come down. So it is better that we shift this, and let's look at the markets from a open interest perspective in terms of what premium makes sense. So in Sensible and the open interest, as you see, the maximum put OI is at 18,000 levels. So if you do not want to take a very risky trade and probably keep a few points still away from 18,000, then I can think of 17,700, 17,800, 17,900 levels seems to be more appropriate. And if the markets do come down, then we still have some cushion for it to bounce back and we would not be under loss. So let me decide to move this to 17,800. We have two options. Either have 17,800 put sold for the upcoming expiry of 7th April or for the expiry of 13th April. The premiums would differ. And let's look at both the strike prices. So if I search by 17,800 for Nifty 7th April expiry, it's currently trading at 17 rupees. For an expiry which is just 2 days down the line, 17 rupees is definitely a good premium to have. And it's for sure double than what we currently have at 17,600 levels. So let's quickly look at 13th expiry as well. So if you look at 13th expiry, it's trading at 72 rupees, which is also an excellent premium. Also given the fact that there is a lead time to go to the next expiry. So let's first exit 17,600, which is trading at 7.85. There are two ways to exit. One at the market price, and it will take the first immediate price to buyer's price to buy back the put option. The second option is to limit it, put a particular strike price, and then execute. Usually limit sell is safer in case if the markets jumps significantly or there are no buyers at around a particular premium price, and hence you may not be sure that when you exited this that you are going to get a right premium price. So let me try to put the exit price here. So an order will be placed. Let's wait for the order to get executed. So let us modify the order. And it got executed at 8.20. So I choose to spread the sell. So I choose to take two orders, which is a spread between current expiry and next expiry. And let me execute the same. $17,800 put sell of 7th expiry to a lot of 100 maybe. I still would have some cash. So let me execute this. And another lot for the upcoming expiry of 13th. Looks like the 100 will not go through because it's asking for 1.97 lakhs. So let me put for one lot, which is 50. Both orders has been placed. In this case, let me just change it to market price rather than limit price so that it gets immediately executed. And we have both the orders successfully executed, which is now reflecting here. So one is 17,800 put sell of 100 quantity for 7th April Nifty at 18 rupees 25 paise premium, and the other is 17,800 for Nifty 13th expiry for 73.45 premium. I hope you learned how to take the positions, how to square off the existing ones, both on the limit and market prices. Happy trading!